Silver just moved into the mid-60s per ounce, printing levels the market has never held before. And the uncomfortable truth is that this kind of move can be the beginning of a new regime or the last bright flare before gravity returns. If you are watching this because you feel that pull, that mix of excitement and fear, you are not alone. Silver has always been the metal that makes confident people talk too loudly and then go very quiet. It does not rise politely, and it does not fall politely. It leaps and it snaps. And right now it is doing what silver does when the entire world is trying to use it for two different jobs at the same time, as money and as machinery. Before we go any further, let me say this clearly. This is education. This is not personal financial advice. I cannot know your risk tolerance, your time horizon, your leverage, or the promises you have made to yourself about how much pain you can take. What I can do is give you a framework, a way to read the story of this move without worshiping it and without panicking in front of it. By the end, you will have a small dashboard in your mind, a set of signals you can watch that will tell you whether the rally still has real oxygen or whether the market is starting to suffocate under its own momentum. The easiest way to get hurt in silver is to treat price like truth. Price is not truth. Price is a vote count in a room full of people who do not all want the same thing. Some of them want jewelry, some of them want industrial input, some of them want a hedge, some of them want a headline, some of them are short because their business demands it. Some of them are long because their fear demands it, and some of them are simply chasing the next candle because they cannot stand the feeling of missing out. So let us start with the claim you clicked for. Silver is at an all-time peak area, and it has more than doubled across this year. That alone is enough to change behavior. People who did not care about silver suddenly care. People who mocked silver suddenly ask about silver. People who have never touched a futures contract suddenly talk about leverage as if it is a toy. And the market senses that shift. Silver can smell newcomers. It welcomes them with a party and then charges them the bill at the door. But the move is not only a party, there are deeper reasons this feels different. Not because silver is magical, but because the world around silver has shifted. There has been a quiet policy change that most casual investors missed. In the latest update to the United States critical minerals list, silver appears as an added commodity. That word, critical, does not mean scarce in the crust. It does not mean the planet is running out of silver. It means supply risk matters to national systems, and demand matters to strategic industries, and concentration matters. And substitutes are not always easy. It means silver is being discussed in the same breath as materials that power a modern grid, a modern military, and a modern economy. If you want to understand why that matters, imagine two different worlds. In the first world, silver is mostly a shiny hedge, a financial mood ring. In the second world, silver is an electrical metal, a chemical participant, a necessity for certain designs and certain performance targets. In the first world, demand can be fickle. In the second world, demand can be sticky. And sticky demand changes how markets behave when investors show up. Now, add something else that has been building for years. The silver market has been running a sequence of structural deficits, meaning total demand has been larger than total supply for multiple years in a row. That does not automatically mean price must rise in a straight line. Markets can run deficits and still see prices fall because inventories exist, because flows shift, because scrap responds, because credit expands, because substitution happens at the margin, but a persistent deficit does something subtle. It reduces the buffer, it makes the plumbing more sensitive, it makes squeezes more violent, and relaxations more sudden. It turns normal news into big moves. And that brings us to the part most people ignore, the plumbing. If you only watch the spot price, you see the wave. If you watch the market structure, you see the pressure in the pipes. Earlier in the year, borrowing costs for physical silver, the kind of rates that reflect tightness and availability, spiked and then around the same time, the market was paying attention to where silver bars were, where they needed to be, and how quickly they could move. That is not a meme. That is the reality of a commodity that must exist somewhere in the world. In a vault, in transit, in inventory, in a factory, or inside a product. Paper can be created quickly. Physical cannot. So when silver explodes upward, we need to ask a question that is more important than the day-to-day candle. Is this move driven by genuine physical stress and industrial pull, or is it driven by financial momentum and crowded positioning, or is it both at once? Because the way it ends depends on what it's doing, the heavy lifting. Let me give you the uncomfortable map of silver psychology. There is a phase where silver rises and nobody believes it. People call it a dead cat bounce. They call it a fake out. They say it always fails. In that phase, the move can be healthy because skepticism keeps leverage contained. Then there is a phase where silver rises and believers start to multiply. In that phase, people begin to justify price with narratives. Some of those narratives are real. Some are half real. Some are simply convenient. Price rises, narrative grows, narrative pulls, new buyers push price, and the loop closes. Then there is a phase where price moves so fast that people stop asking why. In that phase, the story becomes the candle itself. And that is the danger zone, not because it must crash, but because risk becomes nonlinear. A small shock can cause a large move because the market is stretched, and stretched markets behave like rubber bands. Right now, the market is showing signs of stretch. Analysts have pointed out that silver, as tracked through a major silver trust, has risen far above its short-term and long-term averages, reaching deviations that are rare in modern trading. History does not repeat perfectly, but it rhymes loudly here. In past episodes where silver stretched this far, sharp declines followed. Not because the world suddenly stopped needing silver, but because markets punished late positioning and forced a reset. That is the central mystery of this episode. How can a metal that is critical to industry, supported by long-term demand, and reinforced by persistent deficits, still produce sudden, violent drawdowns? And the answer is that silver is not only a story about demand, it is a story about positioning, leverage, and liquidity. It is a story about who holds the risk at any moment, and how fast that risk must be unwound when conditions change. So let us begin where every honest analysis should begin, with what we can measure. We can measure the macro backdrop. Precious metals are sensitive to the dollar, to how yields to inflation expectations, and to risk sentiment. When the dollar strengthens, metals priced in dollars often face headwinds because it becomes more expensive for non-dollar buyers. When real yields rise, the opportunity cost of holding a non-yielding asset increases, and metals can face pressure. When the market expects central bank easing, metals often find support, and when fear rises, metals can act as insurance. Though silver is a messy form of insurance because it also behaves like an industrial input. In recent days, the macro backdrop has been a mix, not a simple one-way street. Data has suggested inflation is not as hot as feared, which can support the idea of rate cuts ahead. But the dollar has also shown firmness at moments, which can dampen metals. This matters because silver rallies can be fragile when they depend too heavily on a single macro level. If the rally is only about rate cuts, a single surprise can shake it. If the rally is about a deeper supply and demand structure, it may survive macro noise, though not without volatility. We can measure the structural market. We can look at supply, demand, and inventories. The silver market is unique because much of its supply is a byproduct of mining other metals. That means supply does not always respond quickly to price. If silver price rises, you cannot simply open a silver tap in many cases, because the mines that produce silver are often producing copper, lead, zinc, and other metals as their primary output. This makes the supply response slower and sometimes counterintuitive. Demand is also complex. Industrial demand is large and often tied to manufacturing cycles. Jewelry and silverware demand is more sensitive to price and sentiment. Investment demand is the most volatile. When investors rush in, they can overwhelm normal flows. When investors flee, they can flood the market. A structural deficit can persist, but investment demand can still swing the price violently in both directions. We can measure market positioning. In futures markets, large speculators and commercial participants report positions that give us a window into crowding. When speculative positioning becomes heavily one-sided, the market becomes vulnerable to a cascade. That cascade can be triggered by a macro surprise, a margin change, a sudden spike in volatility, or simply exhaustion. In silver, cascades can happen quickly because liquidity can vanish when everyone tries to exit the same door at the same time. And we can measure market structure. We can look at the curve, the relationship between near-term and far-term prices. We can look at spreads, at lease rates, at premiums in different regions, and at signs that physical metal is being pulled from where it is abundant to where it is scarce. These signals tell us whether the rally is supported by physical tightness or whether it is mostly a financial phenomenon. So here's how we are going to proceed. We are going to build the breakout case. Then we are going to build the blow-off case. Then we are going to put them in a cage together and see what survives contact with reality. We will not pretend we can predict the exact peak. We will not pretend we can time the exact pullback. We will instead identify the conditions that would favor a continuation and the conditions that would favor a reset. Let us build the breakout case first. The breakout case begins with the idea that silver is not merely expensive today. It is being repriced for a new world. That new world has a grid that needs more conductive material, more efficient electrical connections, more hardware, more energy infrastructure. It has factories chasing efficiency. It has a push for electrification. It has a race for advanced batteries. It has industrial designs where silver is used because it performs, because it reduces losses, because it conducts, because it lasts. Not every use case is irreplaceable, but many substitutions involve trade-offs. And trade-offs matter when scale is large. In this world, silver demand may not rise in a clean upward line, but it may hold up even when price rises, because the cost of silver in many manufactured products is a small fraction of total cost. And because redesigning supply chains can be slow, that creates a kind of inelastic pocket of demand, which can make the market less forgiving when supply is constrained. Now, add the policy framing. When a government categorizes a commodity as critical, it does not immediately change how many ounces exist, but it can change incentives. It can change how projects are financed. It can change how stockpiles are discussed. It can change how supply risk is priced. It can attract attention from institutions that previously ignored the metal. It can encourage domestic sourcing, recycling, and strategic planning. Over time, These shifts can tighten the market because they reduce the willingness to run lean inventories. The breakout case also leans on the multi-year deficit narrative. If the market has been short of metal relative to demand for several years, the missing ounces must come from somewhere. They can come from inventories, they can come from recycling, they can come from substitution, they can come from demand destruction. But if investment demand rises at the same time, the buffer shrinks quickly. When investors buy physical products, they lock up supply. When funds accumulate metal, they remove it from immediate industrial availability, even if the metal still exists and can eventually be sold. This can create a tension between investment and industry. This tension is the heart of silver's volatility. Silver is not gold. Gold is primarily a monetary metal with industrial uses that are relatively small in comparison to varies both. When monetary fear rises and industrial demand remains steady, silver can be pulled in two directions at once, upward in price, because two audiences are competing for the same barrel of ounces. In the breakout case, you would expect to see confirmation in the plumbing. You would expect to see physical borrowing costs remain elevated or at least sensitive. You would expect to see signs of tightness, like persistent premiums in certain regions, or stress in near-term availability. You would expect to see the curve behave in ways that indicate immediate demand for metal, not just distant speculative hope. You would expect to see inventories and flows matter. In the breakout case, you would also expect that pullbacks do not collapse the narrative. You would see dip spot, not because people are irrational, but because there is a real bid underneath, from participants who need metal, from investors who view it as strategic, and from funds who are building positions for a longer horizon. There is another ingredient in the breakout case, and it is psychological but measurable. When a market breaks into new highs, it removes a ceiling that traders have anchored to for years. That does not guarantee continuation, but it changes the map. Old sellers may be exhausted, old shorts may have been forced to cover, and new buyers may interpret the move as validation. If the breakout is genuine, it often consolidates above the old ceiling and builds a new base. So what would a genuine breakout look like from here? It would look like volatility that cools without collapsing price. It would look like the market digesting gains, letting moving averages catch up, letting sentiment normalize, while physical signals remain firm. It would look like the rally becoming boring for a while, which is exactly what speculative audiences hate, but structural rallies often require. Now, let us build the blow-off case. The blow-off case begins with the same facts but tells a different story about which forces are dominant. The blow-off case says that silver has risen too far too fast relative to its own historical rhythm. It says that deviations from trend have become extreme, and that when markets become extreme, they do not stay there because marginal buyers get exhausted and because the next incremental buyer demands a better price. The blow-off case also says that when a market becomes popular, it becomes fragile. Popularity is not stability. Popularity is crowding it, it's leverage. It is narrative compression. It is people buying because the last candle was green. In a crowded market, a small decline can trigger forced selling because some participants are not truly investing. They are renting exposure with borrowed money. When the market moves against them, they must sell, regardless of fundamentals. The blow-off case points to a classic pattern in silver. Silver has a history of spectacular spikes followed by brutal resets, not because the metal becomes worthless, but because the market structure invites squeezes and then punishes the late-stage chase. When the rally becomes vertical, it often ends with a wick, a moment where price surges, headlines scream, and then the market slams the door. The blow-off case also emphasizes that silver is a thin market compared to the amount of financial attention it can attract. A relatively small shift in speculative positioning can move the price dramatically, and in times of high excitement, liquidity providers widen spreads, which makes moves sharper. The market begins to gap. It begins to behave like an argument, not like a calm auction. In the blow-off case, you look for signs that physical stress is not as severe as price implies. You look for easing in borrowing costs. You look for normalization of spreads. You look for evidence that the market has found ways to source metal, whether through imports, through flows between vaults, or through releases from holdings. You look for the sense that the panic in availability is cooling even as the price remains high, which can happen when speculation outruns actual tightness. The blow-off case also looks for the positioning rollover. When speculative longs are heavy, the market can keep rising, but it is like a tower with too much weight at the top. Eventually, a gust hits. The gust can be a stronger dollar. It can be a hawkish central bank message. It can be a simple increase in margin requirements. It can be a big fund deciding to take profit. The trigger does not need to be dramatic. The structure is already primed. And then there is a subtle signal that often appears in blow-offs. The story shifts from why to what. People stop talking about deficits and industrial demand and start talking about targets. They start speaking in absolutes. They start saying it cannot go down. That is the moment you should become cautious. Not because you are trying to be contrarian, but because absolutes are a sign that risk perception has collapsed. So how do we decide which case is more likely? We do not decide with feelings. We decide with dials. Dial number 1 is physical stress. You do not need to be a vault insider to monitor this. You can watch proxies that reflect tightness, borrowing rates for physical metal, signals in the curve, unusual regional premiums, and persistent dislocations. When physical stress is real, it tends to be stubborn. It does not vanish overnight. It can ease, but it often leaves fingerprints. When physical stress is fading, the market becomes more vulnerable to a speculative reset because the floor is weaker. Dial number 2 is positioning and leverage. This is about whether the market is supported by patient capital or unstable capital. Patient capital buys and can sit through volatility. Unstable capital buys with borrowed money and must sell when volatility rises. Futures positioning data, option skew, and the tone of market commentary can give you clues. When positioning becomes a one-sided bet, continuation becomes more difficult because the next buyer is harder to find. Dial number 3 is extension and volatility. When price is far above its long-term rhythm, the market is stretched. A stretched market can stretch further, but it is more sensitive to shocks. Volatility tends to expand. Intraday ranges grow. You see more gap-like behavior. If the rally is healthy, volatility can cool, even as price holds. If the rally is a blow-off, volatility often increases into the top and then explodes on the reversal. Now let us slow down and walk through the story in a way your brain can hold. Imagine silver as a bridge between two worlds. On one side is the monetary world, fear, currency, inflation, rates, geopolitics, the feeling that paper promises are fragile. On the other side is the industrial world, factories, solar panels, electronics, vehicles, batteries, the real economy. Silver stands in the middle. When both sides pull at once, the bridge shakes. This year, both sides have been pulling. In the monetary world, markets have been watching inflation prints, watching central bank language, watching the dollar, watching real yields. Even small changes in expectations can move capital in and out of metals. In the industrial world, the conversation about energy infrastructure and electrification continues, and silver is part of that conversation because of its electrical performance. The question is, which side is driving the marginal move? Because marginal drivers determine reversals. If the marginal driver is monetary fear, silver can move fast, but it can also reverse fast when fear subsides or when the dollar strengthens. If the marginal driver is industrial need, silver's price can be more resilient because industries do not stop needing the metal just because price is uncomfortable. If the marginal driver is speculative momentum, the move can be the fastest of all, and the reversal can be the most violent. So let us talk about momentum without moral judgment. Momentum is not evil. Momentum is a natural part of markets. It becomes dangerous only when participants confuse it for permanence. A momentum rally in silver can begin from something real, like a deficit or a macro shift, and then become self-reinforcing. As price rises, shorts cover. As shorts cover, price rises. As price rises, trend follows buy. As trend follows buy, price rises. As price rises, headlines spread. As headlines spread, retail interest grows. As retail interest grows, options activity rises. As options activity rises, dealers hedge, which can push price further. The market enters a feedback loop. This loop can continue longer than skeptics expect. It can also end sooner than believers expect. The end often comes when the market runs out of clean incremental demand and is left with only the most emotional buyers. That is when a small downtick feels like betrayal. That is when people rush to protect gains. That is when the unwind begins. Now, you might ask, if the market is stretched, why not just short it? This is where silver punishes arrogance. Shorting a vertical silver move is like trying to grab a falling knife that is still being thrown upward. The metal can spike again and again and again. It can do it on thin liquidity. It can do it on headlines. It can do it on a whisper. And if you are leveraged, it can erase you before it ever turns. That is why the right question is not how to be right, but how to survive. Survival begins with defining what you are doing. Are you investing for a long horizon? Are you trading for a short horizon? Are you hedging? Are you speculating? Different goals require different behavior. The same price move can be a gift to one participant and a disaster to another. If you are investing, the question becomes whether the long-term thesis has changed. If the thesis is that silver is being repriced because of strategic and industrial demand, then short-term volatility is expected. But you still need risk control. You still need position sizing. You still need a plan for drawdowns. Silver drawdowns can be large even in bull regimes. If you are trading, the question becomes whether the current move offers a favorable asymmetry. When silver is extended, buying more can be like paying extra for a seat on a roller coaster that is already near the top. You can still make money if it goes higher, but the downside becomes sharper. Risk control becomes the entire game. Stop placement, size, and time frame matter more than narrative. If you are hedging, the question becomes what you are hedging against. If you are hedging inflation, you must understand that silver can move down even when inflation exists. If you are hedging currency risk, you must understand that silver can be influenced by dollar strength. A hedge that swings wildly can still be a hedge, but you must be psychologically prepared for it. Now let us deepen the investigation, because this is where the real value is. When silver makes new highs, it often creates a split screen in the economy. On one side, miners and metal owners celebrate. On the other side, manufacturers worry. Because for manufacturers, silver is not a trophy, it is a cost. If silver price rises too much, it can trigger thrifting, substitution, or demand destruction at the margin. Companies look for ways to use less silver per unit. They redesign pastes, coatings, and components. They negotiate longer-term contracts. They hedge. The industrial world is not passive. This is important because it means silver has a built-in stabilizer over long horizons. Extremely high prices can stimulate behavior that reduces demand growth. But that stabilizer takes time. Redesign takes time. Contracts take time. Substitution takes time. In the short term, the market can still overshoot. So a key question becomes, how quickly can the industrial world respond? If industrial response is slow, the market can stay tight longer. If industrial response is fast, the market can cool, even if investors remain excited. There's also the supply side response. When silver price rises, scrap supply can increase. People sell old jewelry. Companies recover more silver from waste streams. Recycling becomes more economic. Again, this takes time, but it can add ounces to the market. The supply side can also respond through mining. But as we discussed, a large portion of supply is tied to other metals, which makes pure silver supply less elastic. Now let us talk about the most misunderstood element, inventories. People often see inventory numbers and assume they represent freely available supply, but inventories can be pledged. They can be out, they can be spoken for, they can be held by entities that are not price sensitive, they can be in forms not immediately deliverable to certain contracts, they can be in the wrong place, they can be in the wrong vault, they can be in the wrong bar size, they can be in the wrong legal category. Commodities are physical, and physical has friction. This friction is what creates squeezes. If enough participants need metal in the same place at the same time, the market can become tight, even if total global metal is large. Tightness is local before it is global. It is logistical before it is existential. So when you hear phrases like physical shortage, you should translate them into a more precise question. Is there a shortage of deliverable metal in a particular location, under particular rules, at a particular time? That is the real meaning of shortage in many commodity moments. Now let us bring the discussion back to the price we are seeing, because we need to respect the signal without worshiping it. A move into the mid-60s is not normal for silver. It changes the map. It increases attention. It increases volatility. It increases the probability of policy and exchange adjustments. Not because anyone is conspiring, but because exchanges respond to volatility with risk management. That can mean higher margin requirements. It can mean more caution in lending. These shifts can accelerate pullbacks because they force participants to reduce exposure. This is why an extended silver rally can be self-defeating in the short term. The more vertical it becomes, the more likely the ecosystem reacts in ways that cool it. But cooling's not the same as ending. A cooling phase can be a pause that refreshes the bull regime, or it can be the start of a deeper unwind. The difference, again, shows up in the dials. So let us imagine scenarios without pretending we know which will happen. In the continuation scenario, silver pulls back modestly, volatility cools, and price holds above a meaningful area. Physical stress indicators remain firm. Positioning may ease a bit, but not collapse. The narrative remains supported by underlying demand and policy framing. In this scenario, the market is building a higher base. It becomes boring, then it becomes dangerous again later, because the next leg often begins when people stop paying attention. In the blow-off scenario, silver makes a final, sharp push. Headlines reach maximum volume, and then the market reverses hard. Volatility spikes, forced selling appears, the curve normalizes, physical stress eases, positioning data eventually shows a reduction in speculative length. In this scenario, the price may still be higher than it was earlier in the year, but the drawdown is painful and fast. The lesson is not that silver is dead, but that the rally needed to purge excess. In the range reset scenario, silver drops sharply, finds support, then chops for a long time. This is the market digesting. Industrial participants adjust, investors reevaluate, supply chains react. Eventually, a new equilibrium forms. This scenario is frustrating for both bulls and bears because it destroys certainty. Now let me address the fear that many viewers have, but do not say out loud. The fear is that you are late. The fear is that the move happened without you. The fear is that if you buy now, you are the exit liquidity. The fear is also that if you do not buy now, you will miss the new era. This is where the ledger beat matters. You are not here to win a contest of prediction. You are here to make decisions that you can live with. The market will always offer opportunities. The question is whether you will still be standing when the next one arrives. So here's a mindset shift that can save you money. Instead of asking, will silver go up tomorrow? Ask, what must remain true for this bull move to continue without a catastrophic reset? That question turns your attention to conditions instead of candles. Condition 1 is that the macro environment does not violently turn against metals. If the dollar surges and real yields rise and risk appetite shifts, silver can drop quickly even if the long-term thesis remains. Silver is sensitive. It does not like sudden strength in the currency it is priced in. Condition 2 is that physical tightness does not vanish. If physical indicators show easing, if borrowing costs normalize, if dislocations disappear, then the rally becomes more dependent on speculative enthusiasm. That is not automatically bearish, but it increases fragility. Condition 3 is that the market does not become so crowded that it cannot absorb bad news. A healthy market can take bad news and keep going. An unhealthy market collapses on a whisper because it was built on leverage. Now, let us talk about a subtle but powerful tool: narrative tension. The market has a way of creating stories that are both true and dangerous. The story that silver's critical and in deficit can be true. The story that, therefore, price can only rise can be dangerous. The story that industrial demand will force prices higher can be true. The story that, therefore, drawdowns are impossible can be dangerous. In silver, you must separate direction from path. Direction may be up over the long horizon. The path will still include cliffs. So how do professionals manage this? They manage it by respecting volatility. They size positions so that a large drawdown does not end the game. They avoid excessive leverage. They accept that being early is not the same as being right. They hedge, or they diversify, or they scale in slowly. They treat silver as a wild asset that can help you, but can also punish you. Now I want to take you into the engine room for a moment, because this is where most commentary fails. When silver rises rapidly, option markets can amplify moves. Calls become expensive. Traders buy calls instead of spot. Dealers who sell those calls may hedge by buying futures, which can push price up. This is not a conspiracy. It is mechanical. When the market turns, the hedge can unwind and push price down. So options activity can create a feedback loop in both directions. The same is true for certain funds that follow trend signals. When price is above certain averages, they buy. When it falls below, they sell. If silver is far above its averages, those funds may be heavily allocated. If price breaks down, their selling can add fuel to the decline. Again, mechanical. This is why extreme deviations matter. They are not mystical. They are a sign that a lot of systematic capital has already moved in. Now, let us bring the conversation back to your decision making. If you are already in the trade and you are sitting on gains, the question is not, do you believe in silver? The question is, do you have a plan to protect yourself from silver's personality? That can mean taking partial profits. It can mean moving stops. It can mean reducing leverage. It can mean hedging. The exact method depends on your style, but the principle is universal. In silver, you do not wait until you feel fear to manage risk. You manage risk while you still feel confident, because that is when you can think clearly. If you are not in the trade and you are feeling tempted, the question is not, will it go higher? It probably can. The question is, can you handle the volatility that comes with entering after a huge move? If you buy after a vertical run, you must be prepared for the market to pull back hard and still be in a bull regime. If that would cause you to panic sell, then your entry is not aligned with your psychology. There is a simple phrase that can save you here: boring entries, exciting exits. Silver often offers exciting entries and painful exits to those who chase. Patience is not glamorous, but it is profitable. Now, we still need to address the reason this episode exists. You want to know if this is the start of something bigger or the end of something overheated. Let me give you a clear lens. Ask whether the story is expanding beyond finance. When silver's rally is mostly a financial story, it lives in headlines about inflation, the dollar, and fear. When silver's rally becomes a strategic and industrial story, it starts showing up in policy lists, in supply chain discussions, in corporate procurement, and in long-term investment planning. The critical minerals framing is part of that. It suggests that institutions are thinking about silver not just as a trade, but as an input that could become a bottleneck. But a policy list does not guarantee price. It is a signal, not a prophecy. The market can still overshoot, then correct, then build. The long-term story can still be true, even if the short-term path is brutal. So the best answer is not a binary. It can be both. The rally can be part of a long-term repricing and still be overheated in the short term. That is not a contradiction. That is how commodity markets behave. They overshoot in both directions. Now I want to take you through a thought experiment that makes this intuitive. Imagine a town where water is essential. Now imagine that the town's pipes have been running close to capacity for years. Not a disaster, but close. Then one day, a heat wave arrives and everyone turns on their sprinklers. Water demand spikes. Pressure drops. Some neighborhoods lose flow. People panic. The town is not out of water globally. The reservoir is not empty, but the system is stressed locally. Prices spike. Then the town adapts. Some people conserve. The utility reroutes, tankers arrive. Pressure stabilizes. Prices cool. The town still needs water. The long-term need did not disappear, but the panic premium did. Silver can behave like that. Tightness can be real, but the premium can still be speculative. The market can still swing wildly around a real long-term trend. So here is how you can use the dials in real time without being a professional. Watch for cooling, not in price, but in behavior. Are intraday swings getting more violent or less? Are rallies being sold immediately or are dips being bought calmly? Is the news getting louder while price struggles to climb? That divergence can be a warning sign. Are physical tightness proxies easing while social excitement grows? That combination can be dangerous. Also, watch for the emotional language around you. When everyone is certain, uncertainty is highest. When people start speaking in absolutes, risk is reading. Now let me give you a clear set of red flags and green flags without listing them like a textbook, just woven into the story. A red flag is a sharp vertical move that accelerates on headlines without new fundamental information, especially if the market is already extended. Another red flag is a surge in volatility in the sense that liquidity is thinning, spreads widening, gaps appearing. Another red flag is when physical stress signals cool while price continues to surge. Another is when the dollar strengthens and silver ignores it for a while, because eventually macro often gets paid.